If I can ask the panelists to take their seats at the table, and we'll move straight into the afternoon session, which the title says Restoring Europe's Long-Term Potential Growth Rate. We have a great group of panelists here that essentially encompass all kind of experiences and can talk about all the many different aspects of how to boost potential growth. Let me just give a brief introduction to all of them, then they will all speak for about 10 minutes, and then we'll move to Q&A. We have Jay Chopra, who just is visiting fellow at the Peterson Institute and comes here after a very long career at the IMF, where he worked about many other countries, on Germany, on the UK, and also on the Irish crisis, so he has plenty of experience to share with us. We have Carlo Cottarelli, who is now the Executive Director for Italy at the IMF. And before he was Commissioner for Public Spending Reform with the Italian government. And before that, he was the Director of the Fiscal Affairs Department at the IMF. Jacob Kierkegaard, Senior Fellow at the Peterson Institute, and among many other things, expert on labor markets. We have Augusto Lopez-Claros, who joins us from the World Bank, where he is the Director of Global Indicators and Analysis. And he was formerly the Chief Economist and Director of the Global Competitiveness Program at the World Economic Forum. So he will bring a non-Brussels, non-Europe, non-Washington view of what Europe can do to boost potential growth. And finally, we have Hyun Tran, who is the Executive Managing Director at the Institute for International Finance and former Deputy Director of the Capital Markets Department of the IMF. So without further ado, if I can ask each of you to speak for about 10 minutes. I was going to say in alphabetical order, but you can also do it in the order you are seated. It's fine with me. If you want to come to the podium or you want to speak from the chair, up to you. Thank you.
Thank you, Angel. It's a pleasure to be here. One of the drawbacks about speaking in the afternoon after an earlier session and such a great talk by Mr. Sakumani is that a number of the issues one was planning to cover have already been touched on in some way or the other. But one of the dictums of communication is to say it often and say it again. So that's a little bit of what I'm going to do. I have two basic points that I want to make. And the first is that in the euro area, the importance of structural reform and the long-term benefits is not in dispute. Potential growth in the euro area is low, and it's projected to fall even further because of demographic problems. And so the euro area definitely needs structural reforms to improve the long-term capacity to grow. But the problem in the area has been that policymakers applied the wrong medicine by putting undue emphasis on the view that without reform, there can be no recovery. They focused too much on structural reforms at the expense of supporting demand because they thought that the problem was poor growth was due to structural rigidities rather than inadequate demand. So the view was that if you do structural reforms, it'll rekindle confidence and economic activity will pick up. It's very clear that this approach has not worked because supply does not create its own demand. Rather, the immediate problem being faced by the euro area is one of insufficient aggregate demand, and long-term structural remedies are not well suited to address this problem and could even be harmful because they increase the risk of falling into a debt deflation trap. So this brings me to my second fundamental point, which is that additional monetary easing and an expansionary aggregate fiscal stance for the euro area are essential to stimulate demand and to address the immediate short-run cyclical problem. Now, this would also help minimize hysteresis effects. But not only that, by addressing the deficiency in demand, this would also help counter the negative short-term impact of structural reforms on output and prices which will give more room for the long-term benefits of these reforms to be realized. So the point is that aggregate demand policies and structural policies are not substitutes, they're complements. So what I'm going to do is I'm going to elaborate on these 2 points. I'm not going to talk about the demand side issues because I think that has already been covered in the session this morning. So first, let me talk about what happens when you implement structural reforms when demand is depressed. First, let's take the case of good times. I mean, even in good times, many structural reforms can be deflationary in the short run. Labor market reforms that aim to increase wage flexibility allows firms to cut wages. As they cut wages, this allows them to also cut prices to gain market share. The same thing happens when you do product market deregulation to increase competition. The whole idea of competition is to lower markups. So this tends to be deflationary. Also, structural reforms can increase income insecurity, which leads to higher precautionary savings, and then consumption is curtailed, investment gets curtailed, the output gap increases, and this puts downward pressure on prices. So that's what can happen even in good times. Now, in bad times, it gets even worse because these effects get exacerbated when demand is already weak, there's a lot of slack in the economy, and unemployment is high. And this is particularly so when monetary policy is constrained at the zero lower bound, and it's less capable of offsetting the deflationary impact of the structural reforms. You may relax job protection, but this will not stimulate hiring in the short term and might actually increase unemployment. You may reduce unemployment insurance, but if people, the idea being to spur people to find jobs, but if they can't find jobs, it lowers disposable income. You can make it easier to fire labor or to start a new business, but this will have very little effect if firms have excess capacity and cannot find customers. So stimulating demand is essential to provide space for much needed structural reforms. Let me give one particular example. Non-wage labor costs in the euro area are high, and one of the major reforms that is under consideration and done by some countries is to cut the labor tax wedge. But when you cut the labor tax wedge, this leads to a revenue loss. And SGP rules would require you to take offsetting action in order that your deficit does not increase. Now, the latest IMF fiscal monitor, of which Carlo here is a proud parent, has done some simulations to show that when you when you have fiscal stimulus along with these reforms, it helps bring forward the net output gains from such reforms by several years. And in fact, if hysteresis is high, these output gains can be large and they can also be persistent. The second issue, productivity-enhancing reforms. Now, as I said at the outset, the need for structural reforms in the euro area is not in dispute. Poor productivity growth in the euro area was a problem even before the global financial crisis. And after the crisis, the euro area has fallen even further behind. Just to give you a couple of numbers, TFP in the euro area has fallen by 0.8%, almost 1% since 2008, while in the United States it's increased by 7%. That's a huge difference. As we talk about structural reforms, and this was something that was emphasized this morning, but I want to re-emphasize it, it's important to rebalance structural reforms away from, to focus less on deflationary internal devaluation and more on raising productivity. And here I want to quote an ECB central banker. It's odd for central bankers to be talking about these things, but I think Benoit Cœuré did so very nicely when he pointed out, and I quote, Internal devaluation can be the backbone of reform in a small open economy, but not in a larger and more closed one, and even less in the euro area as a whole, where it is by and large a zero-sum game. So much of the focus so far of structural reforms has been on making labor cheaper. But cheap labor alone was not going to produce more innovative firms. So what's needed is a broader and a smarter set of reforms. Now, of course, the specific reforms are going to depend very much on the country. Angel this morning mentioned what he and Adam Posen proposed in the introduction to the ebook that was put out. They suggested that each euro area country identifies its own most important constraints to growth, and then commits to implementing one or two specific reforms each year to alleviate these constraints. This would generate ownership of the initiatives, and I think it's a very good idea that should be pursued. But also, as was alluded this morning, there's a broader area-wide dimension to this problem. And again, time will only permit me to highlight one or two aspects of this. The point I want to make is that work that's been done by the European Commission has documented that the economic structures in Europe tend to be less conducive to technology adoption than in the US. And for advanced countries, it's investment in knowledge-based capital and moving closer to the technology frontier that is going to drive productivity growth. There was a recent paper by Pellegrino and Zingales that focused just on Italy, and they came to pretty much the same conclusion, that the productivity in Italy has been stagnant for the last 20 years. And they've documented with a lot of microdata that productivity problems have been associated with the failure to harness advances in information and technology. So if the focus is on better technological adoption, the question becomes what role can public policy play in this? Because this is really a private sector issue. But I think there is a role that for public policy over here. Again, this is a vast subject, and so I'll just touch on a couple of things. First is in the euro area context, the services market is still relatively closed, and this slows the diffusion of new technologies. In fact, what we see in some countries, even if they import technology, they may take steps to slow its diffusion, and but that's a whole other story. So completing the single market in services and creating a single digital market should therefore be a high priority. There's already been a lot of mention of the issue of the nature of financial intermediation in the euro area. And again, our colleague Nicolas Veron has done a nice essay on the Capital Markets Union. But the basic point here is that it's going to be important to broaden the sources of financial intermediation beyond bank-based channels to create deeper, less fragmented, and more vibrant bond, equity, and venture capital markets. And this should also help innovative firms to get appropriate financing. So those are two examples of what can be done at the broader euro area level. But there's a number of national responsibilities as well, and I don't want to diminish these national responsibilities. And the basic thrust of the structural reforms in countries needs to be to create an environment where resources, where capital and labor can move more easily between failing firms and growing firms. I mean, in some countries, there are rigidities that prevent firms from growing, and this it's not always the case that small is beautiful. I think that there's evidence that larger firms can be more productive. So these rigidities are going to have to be removed. There's issues about insolvency that might have a national dimension, that might have an international dimension. So all of these things are going to have to be addressed to raise productivity. So let me sum up. I think the immediate problem in the euro area is one of weak demand and very low inflation. And this is going to require more aggressive use of monetary and fiscal stimulus. So addressing the demand problem and bringing inflation back up to the ECB's target will provide space for implementing structural reforms that improve productivity growth. The basic point here is that when economic prospects are weak, firms and individuals do not want to invest in more innovation, in enhancing education, in enhancing innovation. So rather, the issue is increasing demand in the short run will make these long-run objectives much more achievable. So unless you deal with the short run, you're not going to get to these the long-run situation that you're really aiming for. Thank you.
Okay. Thank you very much for this invitation, Fred. The focus of this panel is long-term potential growth. So how to revive it, the supply side of the economy. But again, it will be inevitable for me to talk also again about the demand side of the economy. The reason is for discussing the interplay between demand and supply is the vicious circle in which Europe, the euro area in particular, has fallen since after 2007. A vicious circle in which weak aggregate demand reflecting balance sheet effects, as well as the fiscal consolidation that started in 2011, feeds into low potential growth, which in turn leads to a further weakening of aggregate demand. Because of this interaction, the dividing line between demand and supply factors, and as I will explain, is somewhat blurred, and all this makes the solution to the problem more complicated. A good starting point in understanding the current situation is to look at what was regarded the consensus view about potential growth before the crisis in 2007. If you look back at 2007, the EU Commission estimated potential growth in Europe to be about 2.25% at the time, which was, by the way, close to the average growth rate in the 10 days before 2007. The IMF had similar estimates, the OECD had similar estimates, 2.25% potential growth. This potential growth, by the way, was not regarded as adequate, particularly in light of comparisons with potential growth as it was estimated for the United States, and hence the call for structural reform to boost potential growth to a level higher than 2.25%. And again, none of this was new. If we go back to the Lisbon strategy dated to 2000, and we can remember its commitment to make for Europe to become the most dynamic and competitive knowledge-based economy in the world, capable of sustaining economic growth with more and better jobs and greater social cohesion and respect for the environment. So this was before the crisis, 2007, potential growth of 2.25%. Currently, potential growth in 2007 is estimated by the Commission. It was revised down for the euro area to be 1.75%, still pretty high. The current potential growth rate as currently estimated is only 0.6%. With a potential growth rate of 0.6% for the whole euro area and negative for some countries, the potential growth rate of Italy estimated by the Commission is minus 0.3%. The question of how to revive potential growth is obviously for these countries a very important one. Here, however, we should first of all ask ourselves whether it is credible that potential growth declined from about 2% in 2007-2008 to only 0.6% in 2014, and that turned from a positive 1% for Italy to a negative minus 0.3% during this period. Note that we are not talking about a loss in the level of potential output, a one-off decline in the level of potential output, which is what we often find in the aftermath of financial crisis. Here we're talking about a permanent decline, or at least a long-lasting decline, in the potential growth rate of the economy. What does it mean? It means that let's eliminate the output gap. And from that point of view, the European economy, as soon as it starts growing by more than 0.6%, you get into a path of accelerating inflation. I don't think this is really credible. The real issue is that all the methods that are being used currently by the Commissions and by IMF and others to measure potential output growth are basically looking at the past. One way or another are forms of moving averages of past behaviors, and therefore what we mistake for low potential growth is actually a prolonged weakness of aggregate demand. Prolonged weakness in aggregate demand, which in part reflects the inability, for various reasons, as we will see, to use effectively monetary and fiscal policy to support economic activity. This said, however, this weakness, this prolonged weakness of demand is also discouraging investment, and this also weakens the supply side of the economy. And in this sense, it is also appropriate to talk about a decline in potential growth, because the accumulation of capital is occurring at a slower pace. In turn, lower investment implies lower aggregate demand. I'm sorry if I go back to Economics 101, the multiplier, the private sector multiplier. Lower investment leads to lower potential growth, and so on and so forth. In essence, what we see is a combination of the multiplier working in reverse and the investment accelerator also working in reverse. And this affects both the supply side and the demand side of the economy. Does this mean that to get out of this vicious circle, it is sufficient at least to have a boost in aggregate demand? Yes and no. Yes, we definitely need very expansionary monetary policies to support aggregate demand. We will see the extent to which the ECB, how far the ECB can go in this area. Fiscal policy remain constrained not only by the institutional and political constraints of the SGP, but as was noted by Paolo Mauro, by the behavior of markets and the fact that markets are aware of these constraints. So it's not so easy to deal with a fiscal expansion. Unfortunately, this is preventing Europe to do what, for example, the UK, what a conservative government in the UK is doing, namely to keep the deficit at about 5-6%, the fiscal deficit. And doing this in the context of a very expansionary monetary policy. We know this is going to be inevitably difficult for the euro area to do, but there is at least one thing that the fiscal policy in the euro area should do, or at least should stop doing, namely to further to introduce a further drag on aggregate demand by a further decline, a further tightening of fiscal policies. There is a concrete risk that this occurs in the context of weak aggregate growth, simply because of the way structural deficits are computed in Europe presently. Remember, the SGP is designed in a way, was designed in a way that if a country doesn't grow much, there is not much fiscal adjustment that we require from this country. But the problem is that to see whether a country is growing a lot or not, the actual growth rate is compared to the potential growth rate. Now, if the potential growth rate is estimated to be negative in the case of Italy, any growth rate that is positive is regarded as an economic boom. So, for example, Italy is projecting a growth rate for 2015 of 0.6%. For the Commission, this is an economic boom because the country should grow by minus 0.3%. So this needs to be avoided. There is an urgent need of us addressing this issue, which is technical, and so far it has been entirely under the radar screen of all the political discussions. There is another tool beyond the monetary policy, and at least avoiding the fiscal policy is tightened too much, and that's centrally financed spending, centrally financed investment of the type considered by the Juncker plan. This needs to go ahead, it needs to be strengthened as much as possible. Ideally, I've argued this on many times, there would be a need of a much larger central budget to play a counter-cyclical role with its own revenues. It has been mentioned earlier this morning. It's not going to happen overnight, but at least this initiative of centralized spending should move faster. But expansionary monetary conditions and some centralized fiscal support may not be enough. If we do not make sure that the additional liquidity that is available goes into investment in the euro area and does not simply flow abroad through investment by the private sector outside the euro area. In this sense, demand policies are not sufficient and need to be complemented by strong supply policies, and in particular structural reform. They make the euro area, and particularly some countries of the euro area, better. They improve the business environment in these countries and in the euro area in general. Without this, there is a risk that private sector investment will not recover, and without a recovery of private sector investment, there is no stimulus to aggregate demand that is going to work in the long run. Now, the specific reforms that are needed vary across countries. I'm sure that my fellow panelists will go into perhaps these specific reforms. Italy is undergoing very important reforms. The job market reform has already been approved. The judiciary reform is in progress. The educational reform is in process. The reform of the public administration has also started. So in all these areas, Italy is moving ahead. Other countries also need to do the same. Ultimately, the goal should be to revive private investment, which I think is the essential condition to go back to growth in Europe. Thank you very much.
I think I choose to speak from the table, both because I'm lazy, but also because my speaking notes have a considerably smaller font than the previous speakers, and our podium is very low, so I would have to be bending down all the time. So let me start by saying that while I absolutely agree that there's no doubt that the euro area right now is in need of a significant macroeconomic stimulus, I, on the other hand, also find it highly unfortunate that, structural reforms in some ways have gotten a lot of bad reputation. Because, as was said previously in the earlier panel, the two are really, there's no substitute. It's really a matter of complementarity. And I think, so we can sort of think a little bit about why is that? Well, I think the first reason for that is that it's the sort of political economy of structural reform is very similar, or at least the type of structural reform that Europe is going through right now, is quite similar to the political economy of trade policy and trade liberalization, where the cost-benefit distribution is very unequal, it's very skewed, which means that the costs associated with structural reform are very narrow, and the benefits, and typically borne immediately, and the benefits of structural reform are very diffuse, and only come over the medium to long run. And we all know what that does to the ability to mobilize pro or against a particular structural reform. And I also think that, to take the example that Angel brought up in the first panel, I totally agree with him that internal devaluation by wage cutting has been a misguided policy. But I would also say that I don't regard it as a structural reform. What we have seen in the euro area is essentially that it is a fiscal consolidation measure taken by the public sector, which in many countries has been the wage-leading sector, and then in the hope that this would spill over into the private sector and therefore reduce unit labor costs. But as I said, I don't actually think that is really something that should be termed a structural reform. It is, as I said, a fiscal consolidation method. So why has it become to be thought of as a structural reform? Well, probably because there was a lot, in some ways, structural reform was thought, as a better political term than what it really was, namely an austerity measure. I think it also comes from the fact that the erroneous belief that the internal devaluation, or as it was named in the German case, namely wage restraint, was solely responsible for the employment miracle that Germany has gone through in the last number of years. And I think that is clearly not the case. There was wage restraint in Germany, but that was by no means the whole situation. So there are therefore reasons why we have ended up in this unfortunate political equilibrium that makes the structural reform so difficult, and we sort of always end up being back to the old dictum that was once mentioned by the current president, or the new president of the Commission, namely Jean-Claude Juncker, when he said that we all know, and by we he meant then the prime ministers of the governments of the European Union, we all know what to do, but we don't know how to get elected after having done it. And that, of course, creates this problem of sequencing, because it's very easy to go from that statement to a political strategy that says, well, there are certainly certain types of structural reforms that you only do when you have absolutely no other alternative. And I think the reality is that if you look at the euro area crisis, there's some truth in that. There is a whole host of structural reforms, particularly I would here say labor market reforms, that are only being done because countries had absolutely no other alternative. But the problem is, as was mentioned in the first panel, is that strategy or that political economy doesn't work in the situation that we're in now, because there is no acute crisis. There is only this chronic stagnation, and therefore you need something else. And what is that other ingredient that will then push the structural reform agenda. Well, it was mentioned, you could think about contractual arrangement, where it's essentially a bribe to do it. Now, as it was mentioned by our keynote speaker, that didn't work either from those who were supposed to take the bribe or those who were supposed to pay it. Neither wanted it. Or you can simply have, you end up back at this sort of hard to define issue of political leadership. And I think if you look at why is it, there's probably many reasons why Italy, as Carlo just mentioned, right now is going through a whole host of reforms. But I think the one that I would mention the most, why is it that Italy is now finally beginning to fundamentally reform its labor market, and especially Article 18? Well, I think it has to do with the political leadership shown by the current prime minister, which quite frankly was lacking under previous governments. And is that immediately exportable? I unfortunately don't think it is. But I think we should also recognize that structural reforms is not, it's really can be also something very positive. It's not just about undermining the job security of some workers in Europe, or as some most labor unionists and most left-wing politicians in Europe, I think, will say that actually it's really all about undermining the labor unions in Europe. And I think that is a very unfortunate narrative, because you could have many positive, I would argue, or even expansionary structural reforms in the labor market, for instance. They may not, certainly not, they're not the only thing that Europe needs right now. But if you think about increased spending on vocational training, if you think about fundamentally reforming public labor placement agencies, those are, I think, very positive elements. You can think about the other type of structural reforms, namely product market reforms. Most of those, I think, should also be inherently positive, even if they share many of the same asymmetric cost-benefit from it. I mean, if you take the latest proposal by the French economic minister Macron, first of all, I mean, I don't think that that's nearly enough. But if you look at them, he, for instance, proposed liberalizing or actually legalizing intercity bus trips in France, which, believe it or not, had previously been banned because you wanted to protect the TGV high-speed trains. So the fact that you can now actually, or you will soon be able to take a bus from one city to another in France, has to be a positive one. And then there is also a whole host of these issues that has to be inherently at the European level. I don't want to go into the detail of the various versions, whether it's the digital or the services internal market, but there's a lot that needs to be done there. There's another structural reform that I believe must be tackled also at the European level, or perhaps even at the euro area level, which is immigration. There's no doubt that, first of all, I should say that immigration actually is an area where the euro area, or at least the EU 15, have actually done quite a lot. And therefore, you should, it's not a matter of the levels, it's a matter of the type of immigration, and it's a subject that really should be regulated at the European. So there's quite a lot of things you can do. So then I think, when we then think about, since I only have 2 minutes left, the issue of the link between structural reform and the macro stance. Well, I think it's very clear that there is a very clear political link there. That if you do structural reforms, it is very clear that you will get more flexibility on the Commission's interpretation, or at least the EU Council's interpretation of the Stability and Growth Pact. So there's a very clear political link. There's also a very clear economic link, namely that, as was mentioned by Ajay, that many of structural reforms, particularly in the labor markets, might have a contractionary short-term effect and therefore should be associated with a short-term macro stimulus as well. So the link is there. So then, in the spirit of radical responsible excess, as Fred always used to say, let me suggest that one of the biggest links between the macro policy and the structural issues in the euro area will come through QE in the future. Because if we assume that the European Central Bank is going to begin to purchase a lot of government bonds, I absolutely agree with what Jörg said in the previous panel, that the design of those purchases will matter tremendously for the monetary impact of these purchases. But I think that in a structural sense in the euro area, what's going to matter far more is what the ECB does with its bonds that they purchase once they're there. Because if you look at what has happened with the government debt, the national government debt that has been acquired by the European Stability Mechanism, you will see that once that debt, which was initially 7 years, I can't remember what the maturity is, but that has been converted into something that is essentially, the most politically expedient debt profile for the euro area. It's now 25 years, I think, for Greece or whatever, but let's just hypothesize that in the end it'll end up being an 80 to 100-year bond for those loans. So where does that lead the ECB? Well, it comes back to the issue of exit. I would say that exit for any central bank is going to be tricky from QE, but there's no central bank for whom it's going to be trickier than the ECB. So I think the speech that I would like Mario Draghi to give the day after he begins buying sovereign bonds is to challenge the Euro Council to come up with a political decision for what the ECB should do with those bonds. Because if the ECB just decided to do what the Fed's doing, namely to leave it on this balance sheet at its current size, that's an intensely political decision. Or if the ECB, if you look at what's going on in Japan now, I mean, I don't think anybody believes that the Japanese government is ever going to actually redeem all the debt held by the Bank of Japan. That's also an inherently political decision, even if it's unarticulated. So I think that there is, therefore, a very important structural component that goes deeply into fiscal and political arrangement that flows quite naturally from this monetary policy decision that we will, in all probability, see soon. Thank you.
I will try to be less than 10 minutes so that I can share some remaining time with my neighbor and colleagues. I will try to cover 3 key points. One, assessing the current state of European banks, particularly in the euro area. Second, what is holding them up in terms of lending to finance economic activity. And 3, what can be done structurally or otherwise. First, and the assessment of the current status of banks in the euro area has to start from the ECB comprehensive review. Has the review been successful? Has it met expectation? Well, it depends on what your expectations are. So we talk about that in this place many times, so I don't want to go through the key results which are familiar to you, but I'd like to share with you some of my takeaways, which is either in boxes or in footnotes or in discussion of the report of the ECB. Number one, if you look at the main results, the adverse scenario will reduce the end 2013 common equity tier 1 ratio of 12.4 to 8.3, which is about 4 percentage point reduction in the adverse scenario. If you use the standard of a Basel III fully loaded requirement, which will not be coming into operation until end 2018, you reduce that by another 90 basis points to 7.4%. In other words, if you subject the banks not to the currently operating
mandated by law requirements for their capital adequacy, and you accelerate the whole program fully loaded, you go from 8.3 to 7.4. So it is very informative for me because you can see the kind of sensitivity of the banking system depending on where your expectations are. Number two, another complaint is that the stress test has not been using leverage ratio. Well, according to law, leverage ratio 3% is a backup requirement, not the binding requirement. But if you go to that and assume that it's a binding requirement, then the footnotes say that 14 banks at the end of 2013 already failed that 3%, below 3% leverage ratio. And if you incorporate the impact of AQR, asset quality review, which produced loss of the asset and therefore reducing capital, you add 3 more banks falling below the 3% line. So before any stress test, before any adverse scenario, you already have 17 banks below 3% leverage ratio. So I think it is, again, for me, very informative to see from a very simplistic leverage ratio perspective where the banks are. Last but not least, holding of sovereign bonds in the euro areas. Complaint is they should not really have zero risk weight. And indeed, we know that they should not be zero risk. Again, the law is banks will have zero risk weight on their own sovereign in their own country. And the ECB, as the supervisor, cannot expect banks to behave contrary to the law. But they have enough information so that you or us, we can look at it. Banks hold 10% of their assets in sovereign bonds. Let's assume that the risk weight go from 0 to 100%. The scale of thing we are talking about is that we add another 80 basis points to the capital requirement. In other words, whatever ratio we have, it will be 80 basis points lower if you use this calculation to say sovereign bonds holding should be subject to non-zero risk weight depending on their credit ratings. So I think that for me, if you look through these things, the stress test and the comprehensive review has been very useful, presented huge amount of information that really allow market participants to have a much better view and assessment of the health of the banking system. And I think therefore, in my view, it is an adequate exercise allowing the ECB to assume the SSM mandate. The key important conclusion for me from the current state is that number one, the assumption of the single supervisory mechanism by the ECB is a very decisive step forward to implementing the banking union, single banking market, reducing fragmentation in the 18 countries of the euro area, reducing the ring fencing of capital and liquidity that has been really a problem in the member countries until now. Keep in mind that even when we are talking, there are still fragmentation. If you look at the corporate loan rates of the 18 countries, they still are very diverse, despite the fact that sovereign bond rates have converged to a very low level thanks to the ECB. The spread between the core countries and the peripheral countries on average for corporate borrowers, 70 basis points during the height of the crisis, 2011. Today, it's wider, it's 90 basis points. So we have not really begun to tackle the fragmentation in the euro area banking market. And the single supervisory mechanism is a very important step forward. Number two, I think that the single supervision also allow and encourage the consolidation of the banking sector in the euro area. We all know that it is overbanked, and to the extent that cross-border within the euro area consolidation is allowed to take place, I think in the medium term that will be a very significant and positive step forward. And last but not least, the AQR, by pointing attention to the quality of assets of the banks, and I think that is a very unprecedented exercise, has never been done before, nor has it been done by any other supervisor in the world. ECB looked at 120,000 separate borrowers in about 80 loan portfolios of banks covering 57% of the risk-weighted assets of the banking system in the euro area. And they make the assessment, basically, the non-performing exposure have to be increased by 18% to almost 1 trillion, not 1 trillion, 900 billion euro. And I think to me that is the most important conclusion, because it points to a very important change or reform that needs to be tackled, and that is have a consistent, harmonized corporate insolvency regime in Europe, so as to allow banks and encourage banks to clean up their balance sheet, because I will speak later on, this is one of the key impediments holding back banks' ability to take on net new lending and net new risk. So if you look at those things, the problem holding back the banks really have not much to do with the stress test and the comprehensive review as such, because anyone who had expected the stress test to, at the end, produce a vibrant, profitable banking system ready to lend and to finance activity in Europe is simply unrealistic and misplaced expectation. The problem the banking system there faces is still very substantial and many-sided. One is regulatory and legal uncertainty. No one knows where the regime will end, least of all the banks themselves, and under those circumstances, banks have to be cautious and cannot take on new risk. Investors in banks have to be cautious and cannot really put money in banks. So basically, it's a situation where nothing can happen until the uncertainty is over. Second, poor economic conditions in the euro area. We covered that since morning. I don't need to repeat it, but basically means banks are not profitable. IMF estimate that in the next year, even under a fairly baseline scenario, 31 of the 130 banks being stress tested will be unprofitable. And if you look at what has been done in the past 5 years, banks have been induced and under pressure to raise capital. They raised about 725 billion euro of capital. They de-risked their balance sheet by cutting back about 630 billion of assets. No profit. Basically, they have very low return on equity, 1.9% estimated for this year, compared to 7% in the US, 8% in Japan, and 14% in emerging market countries. And because of that, their price to book on average is below 1, 0.8 for the euro area. In the case of Italy, ROE is minus 3%, and price to book is 0.7 times. In other words, they are not profitable, they cannot attract capital, they cannot lend. That's where they are. So that explains the situation we have seen in recent years. In the 3 years prior to the crisis, on average, every year banks lend about €500 billion to the non-financial corporate sector in the euro area. Since 2009 until now, negative every year, almost every year, about €100 billion negative. The problem is not liquidity. Banks have plentiful of liquidity to the extent that they have prepaid the lateral borrowing, totally 734 billion until now. They have about 250 billion remaining to be repaid by February, which they will. And in the 2T lateral that they have taken up, only about 240 billion or so, which basically will be washed out when they will repay the lateral. The cover bonds acquisition by the ECB so far is only 25 billion euro. So basically, I think we spend a lot of time talking about QE, sovereign QE, but personally, I think it's really a sideshow because banks don't need liquidity, banks don't like liquidity. The more liquidity they are given, they don't know what to do with it. And one practical question about sovereign QE is that even if the ECB get around to do sovereign QE, which bank is going to sell their holding of sovereign bonds to the ECB? For example, Italian government bonds give them 2%, zero risk weight. Beautiful things to have. They are induced by regulation to hold more and more government bonds and zero risk-weighted instruments. They sell it to ECB. They don't know what to do. There's no loan demand. They put it back to the ECB. They have to pay 20 basis points to the ECB for the privilege. So who would be doing that in their right mind? So that leads me to the next point, which is basically the same period of time from 2009 until now, when banks delivered, reduced lending every year, capital markets is booming. Non-financial corporations have issued almost 300 billion euro per year on average in terms of new bond issuance, And in the first phenomenon that we have seen in Europe, high yielding or junk bond issuers accounting more than half of those total. In other words, what the banks have not done, capital markets already have stepped up and provide the financing for the non-financial corporate sector. And that leads me to the last point of my remark is capital market union is really one of the key reform, not only for the banking system, but for the financial system in Europe to help Europe overcome the problem that it faces now. And I am more positive when I look at capital market unions compared with the popular perception. It is not just a concept under construction. It already has very concrete underpinning to make it into a reality. First, the common currency, the euro, in 1998 already allowed corporations owned across the euro area countries to issue corporate bonds. Prior to the EMU, absolutely no corporate bond markets in Europe. It's fragmented, it's small, and there's no liquidity compared to what it is now. Number two, Europe and the euro area in particular already has superior infrastructure compared to the US in terms of clearing and settlement of securities. Target 2S, T2S, which will be rolled out July 2015 by the ECB, will allow for efficient across euro area and across EU settlement of securities. It's a single market for security services, and that allow for T+2 settlement. US still T+3. So I think that the underpinning, the plumbing, the infrastructure for a common market for securities, issuance, trading, investing is already there. They need to accelerate and complete the program of reform, particularly harmonize issuing requirements, trading, investing requirements for different players. Tax treatment, we have 11 countries going ahead will impose financial transaction tax. The remainder will not, so it's really disconnect even within the euro area in terms of tax treatment, accounting, and auditing standard. But basically, I think that some basic ingredients have been already in place, and I have a more positive assessment of where the capital market unions can be going. So to conclude, 3 key recommendations. 1, end the regulatory and legal uncertainty. 2, reform and harmonize corporate insolvency regime, basically to allow and help banks to clean up their balance sheet, and that is one of the key impediments, particularly when it comes to banks able, willing to extend net new credit to SMEs. They already have too much exposure to SMEs. Much of that is not performing, but they are stuck in a situation where they cannot do much about it. To resolve and clean up the exposure in some countries take 11 years or more to realize all the tax benefits. So it's just, the incentives are not there. Need to be reformed. And last but not least, we don't need to research or identify individual steps to complete banking union and the capital market unions. Much of the technical needs are known. It's just political will to implement. So I think that if the European authorities, the Euro area authorities in particular, were to able to accelerate implementing the remaining steps in the banking union and then the remaining step in the capital markets unions, in 2-3 years' time, I think the situation will be changed. Thank you.
Angel asked me to provide you a bit of a perspective on structural reform and competitiveness issues in the European Union from the vantage point of the Doing Business report at the World Bank. For those of you who are not familiar, over the last decade, a little more than a decade at the World Bank, we have been putting together a set of indicators that capture different dimensions of the business environment. If you want to know how many days it takes to get a business started, how many procedures, what is the cost, if you want to know what is involved in enforcing a contract in the European Union, if you want to know something about the obligations that have to be fulfilled by a company to pay its taxes, if you want to know something about the protection of minority investors, of registering property, we have those indicators. In fact, we have 11 of them altogether. And over the last several years, they have contributed to a very, very extensive set of reforms in the area of business regulation all over the world, including in the European Union. Angel mentioned that in an earlier job I was doing the Global Competitiveness Report at the World Economic Forum, and I just wanted to mention in passing that the doing business indicators are actually highly correlated with the Global Competitiveness Index. I could show you a chart that shows the distribution of countries in both measures, and it's spread on a 45-degree line very nicely, very, very high correlation. So the doing business indicators are actually a very nice proxy for competitiveness more generally. There are many things that drive the performance in the doing business indicators, and with a specific reference to the European Union, I can think of 2 or 3 things that come to mind very quickly from looking at the data. One of them has to do, I think, with the gradual recognition that one perceives post-2008 crisis in many of the European countries, that one way to get out of the current debt overhang, with many of these countries now with debt levels in excess of 100% of GDP, is essentially to create a more friendly environment for the private sector. In conversations with authorities in Madrid, in Rome, in Athens, it's evident that there is already an understanding that more needs to be done in terms of improving the investment climate and creating an environment that is more favorable to private sector activity, because after all, 90% of all the jobs are created in the private sector. And this has been very encouraging, and it's actually been reflected in the doing business data in the last few years. Countries like Italy, like Greece, like Spain have actually made fairly remarkable improvements. I don't want to overemphasize the importance of these improvements, but I do mention that there is this recognition and that active efforts are underway to address some of these structural rigidities which are revealed by the doing business indicators. The other thing that is happening, which is intrinsic to the European Union, is basically that you have countries like Poland, like the Baltics, Latvia, Estonia, and Lithuania, the Czech Republic, countries that, if you go back, let's say a decade ago, were very much engaged in a very strong process of institutional and economic reforms ahead of entry into the European Union. And many of these countries have actually continued on that path of reform. The incentives have changed, of course. Now the incentive is that a country like Poland has to compete against Sweden, has to compete against Germany, and that has kept these countries on a path of reform that is actually fairly impressive. Not to say that they don't have other challenges and other problems with macro management, but at least in those areas that we cover in doing business, one sees a fairly sort of consistent pace of reform. And this actually now has gone to the periphery of the European Union, because as you know, the European Union at the moment is having discussions with a dozen or so smaller countries that are going to be future members of the Union. And one sees in these smaller countries the same kinds of incentives that one saw in Poland and in the Baltics and in others a decade ago. That is, that they want to shape up, they want to become members of the European Union. There is a very tall agenda of reform that needs to be implemented, and they're at it. And that's encouraging. The other force has been technology. One of the indicators that we look at in the doing business report is paying taxes, and one subcomponent of this indicator is actually the time that it takes to prepare, to file, and to pay your tax obligations. And if you just look at what has happened to this indicator over the last, let's say, decade in Europe, it has been a fairly sustained reduction in the number of hours. You can take this as a kind of a proxy for tax administration, on the burdens of tax administration, and both on the time component and the actual number of payments, there has been a very substantial reduction over the last decade. And what is more encouraging even is that some of these improvements in tax administration have then been passed on back to the private sector to lower taxes. The corporate tax rate on average has come down, throughout the European Union, in some countries more than in others. What I'd like to do in the next few minutes is just to give you some of the data that is coming out of many years of doing business with a specific reference to the European Union. Just to give you a sense of what is underway, some of it is encouraging, some of it reveals that there are still many outstanding issues and problems which need to be addressed, which are very much at the heart of what low growth in Europe. If you go back to 2005 and you ask yourself, in how many countries in the European Union did it take less than 20 days to get a business started? It turns out that there were 10 countries. However, by the last report, which was issued a couple of months ago, the number had risen to 25. 25 of the 28 countries. That's a fairly important increase. In fact, the only 3 countries in the European Union where it takes more than 20 days are Austria, Poland, and Malta. In fact, if you just dig into the data a little bit more, not only are you impressed by what has been done, but actually in some countries the change has been really quite seismic. Spain, for instance, if you go back to 2005, was the laggard. It was the country in the European Union where it took 70 days to get a business set up. By last year, that number had come down to 13. Portugal was the 3rd worst performer in 2005. It took 48 days to get a business started. By the last report, it took 2.5 days, and it was the best performer in the European Union. Again, I don't want to over-dramatize this. I think that there are many outstanding serious issues in the European Union, but there is a noticeable willingness as you engage with partners, as we travel and we visit many of these authorities. There is a sense of urgency which is being reflected gradually in the doing business data. Having said this, when you look at the totality of the countries, the 28 members of the European Union, there is actually a kind of a large diversity of performance. In the top 20, you have 7 members of the European Union, because we do this for 189 countries and we rank the countries, which is one of the reasons why the Doing Business report has acquired such notoriety more generally. It has become the flagship publication of the World Bank. Well beyond the World Development Report in terms of copies downloaded, copies sold, and so on and so forth. And so we have Denmark, the United Kingdom, Finland, Sweden, Ireland, Germany, and Estonia as the 7 countries in the European Union that are among the top 20 in the doing business. And then the rest, the other 21 members, go down the line all the way to 94, which is, I think, Malta, which is the worst performer. Therefore, because you do have lots of European Union members in the top 20, you have many examples of best practices in the world. In places like Denmark, like Sweden, like Germany, depending on the indicator that you look at, you have some of the best business practices, some of the best institutions, strongest institutions, less complex procedures, and so on. And in general, a business environment which, at least as in the areas that we captured in the doing business indicators, are doing quite well. However, as I said, there are problem areas as well, and in the next few minutes, I just like to give you 3 or 4 examples of the kinds of things that I think sometimes are serious problems in Europe and are revealed through the doing business data. One of them has to do with the tax system. For instance, Italy has a ranking of 141 out of 189 countries in the paying taxes indicator. France has a rank of 95. If you look at what's going on, you see that in both cases you have fairly heavy burden of taxes. One of the subcomponents of the paying taxes indicator is the total tax rate, and it's very high, among the highest in Europe. In the specific case of Italy, you also have a problem of tax administration, very cumbersome, long times, lots of payments. The business community in Italy operates under a heavy burden of tax administration, at least as we measure it. Some countries like Sweden, which in general does quite well in doing business, have high labor taxes. Employer social contributions have an impact on the demand for labor, and when these contributions are very high, we have noticed that they tend to be accompanied by sort of incentives for informality and for evasion. And indeed, if you actually look at the data on informality, Sweden has an informal economy that is something like 14% of GDP, which is twice the size of Switzerland and Austria, which have lower levels. High labor taxes, of course, pays for social benefits in all the European Union member countries, but there is evidence that they are beginning to affect adversely certain groups, young people, older workers, low-skilled, new entrants, and so on. More generally, of course, there is well-established empirical evidence about the adverse impact of very high corporate tax rates on things like aggregate investment, foreign direct investment, entrepreneurial activity, the size of the informal economy, and so on. Within the European Union, in countries like Ireland, Denmark, the United Kingdom, Finland, we see a tax environment that is much more conducive to private sector activity and also a much lighter burden of tax administration. One of the indicators that we look at, which I think is a very interesting one, is called enforcing contracts. And basically, it takes the perspective of what it takes to enforce a contract through the court system. If you're a business head and let's say that you have made a down payment on, to a supplier for the delivery of some goods and the supplier doesn't deliver, and you have to enforce the contract to the courts to get your money back, what is involved? How many days? How many procedures? What is the cost that eventually you will pay for enforcing a contract? And in places like Italy and Greece, it takes somewhere between 1,200 and 1,600 days. In other words, we're talking about years to enforce a contract to the system. In Italy, it will eventually cost you something like 23% of the claim, and it involves an actual 37 separate legal procedures, through the 3 or 4 years that you're going to be in court trying to enforce the contract. The reason I mention this is because you would not be surprised to see this kind of very heavy burden on, in countries in the developing world, but you see this actually in members of the European Union, and it's something that undermines competitiveness. It's something that makes life for the business community extremely, extremely difficult, because you're going to be tied up, fighting these legal battles for years and years and years, and it's going to be costly and discouraging, to say the least. One of the indicators that we look at is registering property. It's very important because if the property registration regime is efficient, it means that businesses can access the financial system by using their property for as collateral. And therefore, it has a kind of a real economy, dimension to it. And again, if you look at the data for Europe, it's you see a great deal of diversity of practice. You have countries like Denmark and Lithuania, where it takes 2.5 days, 3 days, 4 days to register property. You go to Belgium, and it takes 8 procedures, it takes 65 days, and it costs an arm and a leg, something like 12.5% of the property value, which is sky high if you think about it. So again, great diversity of experience. One area which I would just mention to conclude is the labor market. Again, a great deal of diversity of experience. You have countries like France and Portugal, that have in general very rigid labor market. Depending on what you look at, if you're looking at the length of fixed-term contracts, if you're looking at issues of the notification requirements for instance, removing people from the payroll, if you're looking at issues of redundancy payments and the conditions for redundancy. If you contrast France and Portugal, for instance, on the one hand, with countries like Denmark and the United Kingdom on the other, you have really wildly dramatic experiences. Same business community in supposedly a fairly integrated European market, and yet, the experience of the business community varies quite strongly. Nevertheless, I'd like, there has been a lot of gloom and doom around the table in the last hour or so. What I'd like to say is that from the narrow perspective of the Doing Business indicator, the story that is coming out of Europe is a little bit more encouraging. To come back to my earlier point, we see very, very much governments in Italy, in Spain, and Portugal, in Greece, which have been at the center of the euro crisis, extremely engaged and very, very much focused on private sector development and measures of competitiveness. Maybe it's not going to be enough to forestall the next euro crisis, but at least I am encouraged that they have come to that recognition and they're doing something about it.
Thank you very much. I think this has been a fantastic discussion, and I think it's good we ended on that note. I have to say I'm reasonably skeptical that potential growth in the euro area is as low as 0.6%, or that it could be negative in a country. I don't completely understand the meaning of short-term potential growth, but that's a different story. I think we would have time for 1 or 2 questions. I have let the panel run as much as possible because this was very interesting, but please identify yourself and ask.
Hi, I'm Patricio Pagano. I'm Executive Director at the World Bank. I have a comment and a question for all the panelists. A comment is related to what Augusto just said. If one looks at the doing business indicator at the subnational level, you can look at a great deal of diversity within country. That is, if you look at, for instance, the time to enforce a contract in Italy, there's a wide diversity from Turin to, say, other cities, which leads me to think that it's not a country effect. It's not the fact that a country has a legislation that forbids the best practice. So maybe the point is the political economy of the reforms, not the technology. I would like to have your thought on this thing. Thanks.
Anybody? No, please.
The point that Mr. Pagano makes is actually a very important one. You know, we do subnational doing business work in many countries, which basically means we take the indicators and we estimate them at the level of the cities or the regions of a particular country, as opposed to the largest business city, which is what we do in the global report. And what he mentions is absolutely true, that if you go to a country like Italy, where a couple of days ago years ago we did a subnational doing business study, and you look at in which regions of the country are the best business practices located, what you will discover very quickly, as we did in Italy, is that actually there are a lot of places in Italy, other than Rome, that are already operating at a much higher level of competitiveness and efficiency. And you can actually derive a kind of a hybrid indicator for Italy based on the best business practices in the various cities. And it turns out to be that is, many, many places ahead of the global ranking that they get on account of Rome. And this is very encouraging, and you're absolutely right. It shows that, in fact, good business regulation and competitiveness enhancing reforms are possible within the country. That yes, we know that it's not New Zealand, it's not Singapore, which are the two top performers in doing business, but the fact that you do discover these good business practices within the national territory suggests that it can be done.
Anybody else wants to comment on this in the panel? No. Any other question down there? Yes, go. You can go to the mic.
Thank you, Angel. Alex Spiriter again from ARCGS. I wanted to, since Hang, you've been quite down on the effectiveness of quantitative easing, but we've also learned that Europe hasn't been standing still, and some structural reforms have been implemented. Therefore, the business climate could potentially improve given a chance. So despite all the constraints that you see for the financial sector, particularly for European banks, and those even will be ongoing despite what the CA means for the European banking sector, as you have pointed out. Do you see a chance that QE could, in fact, be effective and banks could feel encouraged to swap, let's say in the case of Italian banks, sovereign bonds for some kind of other assets, and therefore the circulation of liquidity could increase despite the ample liquidity that there is in the system, but seems to be parked in many instances and therefore is not flowing freely? Thank you.
Well, thank you. Please do not get me wrong. I am not opposed to QE. At this point, I'm grateful for anything that anyone can do to help the system. I just think that it will be helpful, yes, but kind of marginal. So do we need it? Do we appreciate it? Yes, we do. Because the absence of it will make things, not improving. So number one, yes, I would positively look at, expect, and appreciate and welcome additional step by the ECB, QE, and sovereign QE if they can get around the political constraints. Number two, this back to the catch-22 issue, because if banks can find assets that are acceptable for them on a post capital, requirement basis, which is attractive, they would have done it so because they have plenty of liquidity. So the challenge is between zero risk weight government bonds, which by a variety of new regulatory requirements, between capital requirement, liquidity ratio requirement, TLAC, and so on. It is very valuable for banks to hold these zero risk weight government bonds. Now, is there anything else that can be more attractive to banks compared to that? At this point in time, it's very difficult to see. If there's a more attractive alternative, I'm sure that banks will move on to earn some more yields and get some more revenue. So the whole context of what I try to say is the relationship between bank lending and economic activity is contemporaneous. Bank can lend and provide funding for economic activity, but vice versa. Economic activity and loan demand is also very important for bank to lend. Right, but therefore we are operating really at the margin of what can be done to improve things. Yes, the spread between Italy and Germany is about 100 basis points or thereabout. So therefore, theoretically, there is room for Italian government bonds to go even further down and to get closer to German bonds. Yes, but if you step back and you say, with a country like Italy, with the rating it has, with the debt burden it has, with the track record in growth and so on, compare, say, with the US, the Italian government bond is yielding below US government bonds. Does that make sense? No. So do you want to accentuate the distortion that is already there because of QE and zero policy rate and ton of liquidity? No.
I guess another way to put that is that the regulatory tightening is so intense that interest rates have to go down even more in order to offset that. We have a final question down there. Bill.
Today has had the dominant perception that Europe has this huge output gap, the US doesn't. So I'd like to ask how we should think about the fact that the official documents, or the data by the IMF, the World Economic Outlook, say that the output gap is identical for 2015 in the euro area and the United States, 2.5% output gap. I suspect Carla will say it's just bad methodology, but but it does seem to me that we're kind of flying blind if the principal entity which is responsible for characterizing the macroeconomic context for the decisions that are made does not make the kind of distinction that everybody here seems to share.
Anybody wants to take that?
Yeah, what you just referred to is the bad news. The good news is that the next WEO, there is going to be a reassessment of the potential growth methodology, and so presumably this is going to lead a re-estimation of the output gap in the euro area. So this is going to be the focus of the next, one of the chapters of the next WEO is going to be about potential growth, precisely because it has been acknowledged that there is an issue.
Okay, I want to ask if anybody of the panelists have any final comments, anything to add?
I think on this point, I would also point out the unemployment rate, which is around 11%, and that's got to be, considerable slack in the labor market.
Thank you. And with this, I think we conclude this panel, and now Fred Bernstein is going to conclude the session.
No,
Thank
just
you.
let me conclude by saying thank you to all of the key participants, particularly thanks to our friends from the Italian Embassy and the Italian chair of the community for stimulating the event. Thanks to all of the panelists, both now and this morning. Terrific job. Thank you again to Fabrizio for a wonderful luncheon presentation. Thanks particularly to Angel and Jacob for chairing and organizing the session. Thanks most of all to all of you for coming. Meeting adjourned.